Hello, Dalia. Oh, thank you for coming back to my show. So we have a lot of things to discuss about. Wow, the last few weeks, whew, there's been some massive changes in the US banking system. So I definitely want to talk to you about that. Should we be worried about our mortgages in the Canadian banks? Also, just some considerations, like now that Bank of Canada is holding off their rate cuts, what does that mean? And for those who are renewing your mortgage or looking to get a mortgage, you definitely want to watch today's video. So back to you, Dalia. Okay, let's talk about in the last month, we've seen a bunch of smaller banks in United States that have collapsed. So I think the audience is probably wondering, like, how should we feel about our mortgages, especially if maybe we have a mortgage with, say, a credit union, um, or like with a trust company. Like, can you just share your perspective?
Absolutely. So remember, Tracy, when we had a disaster in the US back in 2008 and 2009, and there was a global economy meltdown, we here in Canada um, really showed the world that we've got a solid banking system and a world class financial system. And I remain confident in that because here we have more stringent regulations. As we all know by now, the stress test has been around for quite some time, and in fact, it is partly it's served Canadians. I know as much as we all did not like it to go through a mortgage application and go by a higher rate for mortgage approvals. That's what's actually helping Canadians right now adjust their monthly budget to deal with the higher rates. Okay, so we have more stringent underwriting guidelines, more stringent regulations here. Liquidity is different, and the number of players in the Canadian market are not the same. We've got X number of banks that I can count on my fingers versus in the US, you've got a lot more banks and much more smaller banks, many small banks that are market focused. So what I'm trying to get to is here we've got more stability because of how things are done in Canada. So I wouldn't be concerned about a mortgage being with a smaller player versus a larger player here in Canada. But what I can tell you, the impact of what's happening in the US will spill over here in the sense that we will probably see tightening of lending a little bit because the regulators are um, obviously concerned about the uncertainty in the market and they want to protect Canadians, they want to protect the system, and they're going to ask the banks for higher liquidity requirements. So the banks are supposed to put more money on the side just in case to be safe. And what that means is lending may get tighter a little bit. So that's what I foresee happening here in 2023. Regulators coming forward with tighter guidance.
Oh, tighter guidance. Great. It's like it's already, I
But
mean, this is what's
painful.
saving our butts, but I
Yes,
mean, it
but
saved our
it
butts
is
during
it
the
is
financial
painful. I
crisis.
mean, lending always is like a pendulum, right? It swings. There are times of tightening, and then midway, and then it goes back into easing. So we are in that tightening cycle right now, and it's going to get tighter because of what's happening in the U.S.
Yeah, I did read an article, I think it was December 2022, where Bank of Canada did ask the top six banks to increase their capital requirements. I thought it was like, oh, I don't know if they saw something, but they definitely asked this in December of last year. So
Yeah.
that was a good call. But of course, if they're asking them to increase their capital requirements again, then yeah, then for sure, what does that mean in terms of lending out? That means they need to keep more of the capital, right? Rather than lend out the capital. Um, Okay, well, I'm glad that to hear that, you know, we have really not many banks compared to the United States, and that we should feel comfortable having our mortgages with the banks in Canada. You were about to say something, Dalia. Sorry, I interrupted you.
No, it's just that really the capital requirements, increase in capital requirements means that more money's sitting here than being lent out, essentially. Uh, or if the banks want to lend out the same old way, uh, they have to beef up their capital requirements, which is expensive to them. So this is why I'm saying that we're probably going to see a little bit more tightening when it comes to lending, meaning regulators will ask the banks to limit their exposure to certain markets, certain products, um, not lend as much to certain types of on certain types of properties, things like that.
Okay, well, I guess we'll see if
I'll keep you posted as things,
yeah.
you know, roll. I'm just giving you early indicators of what's likely to happen.
Right, because this is a pattern that could you've seen during the financial crisis. Like we've all unfortunately we're dating ourselves, but we saw it. We saw it, we experienced it. Okay, so then now that Bank of Canada is holding rates, which is a good news, which is a great sign. Fingers crossed. And now there's some speculation that the rate cuts could come sooner than later because likely the U.S. banking system cracking is a sign of potential problems, and we may have a rate cut earlier than 2024. So, what can people do now if someone is looking for a mortgage now or looking to renew their mortgage? What can they do to help prepare for it? So I know there's some considerations you definitely want to point out about the rate changes, the fixed versus variable, because there's something weird happening between the fixed and the variable that we really want to touch. Okay, you guys watch this. Okay, you definitely want to listen very closely. So let's go into that.
Yes. So when you say something weird is happening with respect to the rates, here is what's going on right now. The fixed rates have actually come down. So if you look around for a 2-year fixed, a 3-year fixed, a 4-year fixed, or a 5-year fixed, these rates are actually below right now where the 5-year variable rates are. That's an interesting, place for the rates to be. And here is what you need to think about if you're going to make a rate decision, whether you're going to purchase or you're up for renewal and you need to make a decision. With the rate cuts now on the horizon, and we don't really know if they're going to happen in 2024 as initially expected or earlier because of what's happening in the US and also because the inflationary pressures are starting to ease up. Okay. With that on the horizon, here's what you need to consider. You want to benefit from what's going to happen, right? You want to ride that roller coaster down. Okay, we all went up the curve if we were on variable rates or adjustable rate mortgages, but now we want to go down the curve and benefit, right? And when cuts happen, they don't happen in a straight line. They happen 25 points and then another 25 points, and they gradually go down. So you want to benefit from that. So don't be tempted. Where I'm going with this is if you're going to make a rate decision today, you can take a 1-year fixed, okay? It's going to definitely be cheaper than taking a 5-year variable, but you have to think about now the 2 or 3 or 4-year fixed because you may be tempted to take one of these because your payment is going to be better because the rates are lower, but you're going to lock yourself into a longer period. And fast forward 12 months from now, if you're in a fixed rate that is long term, I think you're going to get very frustrated seeing the rates go down where you're locked into a higher payment and a higher fixed rate for 2 or 3 or 4-year terms. So definitely, in my view, don't take a 5-year fixed or a 4-year fixed or a 3-year fixed. One is what I would recommend so that By the time the rates start to go down, you're up for a renewal and you can ride the wave going down the variable or take another short term. So don't be tempted to lock into a fixed rate today just to get a payment relief, okay? Because you're going to regret it later, is where I'm going with this.
Right, because we're saying if it's projected, even if it's like the rate cuts are expected, like say it happens in 2024, you want to ride the way down. And if you lock yourself into a 4-year fixed right now, then you're locking in at a higher rate that could be dropping. It's expected to drop actually in 2024 or even earlier. So what are the examples of this weirdness? Can you point an example like of what we're seeing, like a variable versus a 4-year fix?
Yeah, so remember the fixed rates are driven typically by the bond market, okay? The variable rates are driven by the central bank's decisions with respect to the overnight rate, so prime rate, right? So the bond markets have responded to what's happening with a softening, and therefore the fixed rates have come down. Give you an idea, 2 years fixed today, I'm just using, reading off one of our lenders sheets today. 2-year fixed is 5.7. This is conventional, meaning it's not a 5%. It's at least there's 20% in the deal, right? We're not talking about insured deals here. 20% in the deal or more. 2 years fixed is 5.79. 3 years fixed is 5.39. So going down. 4-year fixed is 5.39, still as cheap as the 3-year fixed. 5-year fixed is 5.19. And then the variable, 5-year variable, is at prime minus 70, which is 6%. So the longer the term, the cheaper the rate on the fixed rate side. So you may go, that's a no-brainer. I'm getting a lower rate locking into a 4 or 5-year fix. Why wouldn't I? But that would be a very short-sighted decision.
Oh yeah. You know what? Actually, that brings me to mind when I was during just before the financial crisis, I locked into a 5-year fix and I thought it was like a greatest deal ever. It was 5.69%. And then obviously financial crisis happened and the rate just started plummeting down and I did not. And in order for me to get out of a 5-year fix, I had to pay a huge penalty. Like I think it was like $40,000 or $50,000 to get out of it. Yeah, I think I might even talk to you about this, Dalia, way back. So definitely do not do that. If we are projecting potential rate cut, which is looking likely, because Bank Canada's already held the rates, and hopefully, trend keeps going. Then if we have rate cuts, then you don't want to be locking into, like you're suggesting, a long-term fixed rate. So just to clarify one point, I even though we've been talking about mortgages for so long, I still get confused about an adjustable rate mortgage versus a variable rate mortgage. Can you just please explain that before we go into the next topic of the adjustable versus variable rate?
Yes, that's a very timely topic, by the way, that you bring it up. And here is the key difference. Some banks market a variable rate mortgage. They call it a variable rate mortgage. They don't call it an adjustable rate mortgage. So you got to be careful about the terms. Whether you hear the word variable, if anytime you hear the word variable, just dig deeper is what I'm suggesting. But here, technically, one should be called an adjustable rate, and the other one should be called a variable rate. So what's the difference? Both of them actually depend on the interest is calculated based on prime rate. So as prime goes up, the interest changes, okay? With any variable rate product. But adjustable rate, your payment would change. So if the interest goes up, your payment resets and it goes up to maintain your amortization. So those who are in an adjustable rate mortgage during this monetary tightening mountain climb felt the pressure because obviously their payment has gone up and up and up and up in up to 400%. However, they've kept their mortgage paid down on track. So if they were supposed to pay down their mortgage in 25 years, that is staying on track. If you're in a variable rate mortgage, your payment doesn't change. As the interest rate changes, what changes is how the payment is split beneath the surface. So if interest rate goes up, less goes towards principal, more goes towards interest. So again, during this mountain climb for the past 6 months, for many, that payment stayed stable, but now they're looking at their amortization schedule, and their amortization is 60 years, 70 years, and so 120 years amortization.
Okay, so yeah, that's great. 100-year mortgage. Okay, that's not cool.
Until they hit something called the trigger rate, and then, in some cases, the banks would call and say, hey, we need to reset your payment, or you need to make some payment beyond just being at all interest. And that's what happens on this side of the equation. So here's the thing. When the interest rate is going up, a variable rate with a fixed payment gives you a little bit of relief, obviously, because you don't feel the bump, right? Going up the roller coaster until you hit what's called the trigger rate. So now rate declines are on the horizon. So this is really important. If you're going to take a variable rate today and your payment is going to be fixed, as the rates go down, your payment is not going to change. Beneath the surface, you're going to pay more principal versus interest, but don't be surprised if your payment does not change, because that's how the product is designed. But if you take an adjustable rate, as the rates go down, your payment goes down, rate go down, and payment goes down. So key distinction in terms of product features there. Don't just look at the rate.
Right, the interest rate you meant, right? Like, don't
Yes.
just look at the interest rate. So you're saying if interest rates start cutting, which is projected to cut, so which would be a preferred product? It sounds like it's the adjustable rate mortgage, not the variable rate mortgage.
Yeah.
Yeah. Okay. And also not to also lock into a long-term 5-year fixed rate either, because it doesn't look like you'd be like kicking yourself. Okay. So this is fairly, like, even though we've talked about this so many times, I'm still like, every time we talk, I'm like, okay, I got to remind myself what this means. So I hear you have a promotion. I believe people should definitely talk to you and your team if they're in this situation where they're considering refinancing or getting a new mortgage. Definitely talk to your team, because these topics can be fairly complicated, and you got to be sensitive to the trends in interest rates. So let's talk about the promotion that you have.
Yes. So, like you said, we're guiding a lot of clients, many clients right now with their rate decision, and we're happy to help on that front. But also, we're seeing momentum again on the street when it comes to property purchases. I talk to many realtors, real estate investors, obviously, and the purchase activity is increasing. So, we're offering to cover the legal fees, excluding disbursements, on deals above $800,000 of required mortgage. If clients submit their application to us anytime between April to end of June, which is the, like the spring market. So we're covering the legal fees on these purchases, excluding the disbursements.
Oh, that's amazing. Well, I mean, not only does your team just know a lot about these topics and deal with complicated matters with real estate investors, but you're giving them an incentive to talk to you, which is like less money out of the pocket to pay legal fees. So, of course, Dalia, where can people find you?
Info@streetwisemortgages.com is the easiest way to get in touch with us. And if you want to benefit or tap into this promotion, just have the word purchase promotion in the title, so we know that it's something, to extend to you.
Awesome. Okay, great. So, well, next time, I hope we can talk about maybe there could be an interest rate cut, or maybe you'll know more, or maybe if there's stricter lending guidelines, that definitely we need to also talk about that. Okay,
Yes.
thank you so much, Dalia. It was a wonderful interview. I'll
You're
see
welcome,
you
Tracy.
I'll see you again next time.